Hello again from me, Rossouw. Thank you for joining me for this month's economic and market overview. I'd like to spend the next 20 minutes or so talking to you about the COVID-19 pandemic and its impact on the economy and investment markets. I'd also like to share the Adviceworx outlook for the rest of the year with you. Over recent months, inflation has overtaken COVID as the primary global concern. While the pandemic is showing signs of abating, inflation has become a major headache for the world central bankers. There is an interesting interrelationship between the two phenomena. At first, COVID had a deflationary impact on the global economy as some people lost their jobs and others deferred spending. Monetary and fiscal authorities responded by pumping money into the economy in order to prevent a recession. More recently, the pandemic's impact has shifted from the demand side to the supply side. Consumer spending has largely recovered, but due to COVID-induced supply chain bottlenecks, we now have a classic example of too much money chasing too few goods. By the end of January, more than 376 million people had been infected with COVID-19 worldwide, and 5.75 million people have by now succumbed to the disease. The United States remains hardest hit, with more than 76 million infections and 908,000 deaths. India, Brazil, France, and the United Kingdom make up the rest of the top 5, and South Africa has thankfully moved down from 18th to 19th position in terms of the most recorded cases. The Omicron variant, whilst more contagious than previous ones, does seem to be less lethal than its predecessors. America, Britain, and Europe are now the epicenters of the pandemic, and to date, nearly 5 billion people have received at least one dose of COVID vaccine. More than 10 billion doses of vaccines have now been administered, and an estimated 52.5% of the world's population can now be regarded as fully vaccinated. Sadly, low-income countries remain at the back of the queue as far as vaccination is concerned, and there's also concern over the fact that the daily vaccination rate has dropped significantly. Even though inflation is a global concern, its nature and extent varies from region to region. In America and Europe, CPI is at multi-decade highs, but in Japan it is subdued, and in China it is actually slowing down. There is also a divergence in monetary policy responses. The US Fed is expected to hike interest rates 3 to 4 times this year, while the Chinese central bank has already cut lending rates twice. This combination of higher rates in the West and slower growth in China is bound to detract from global economic growth, and commodity producers will be impacted if Chinese demand weakens. China has long been one of the key drivers of global growth. Now there are a number of dark clouds over its short to medium-term economic outlook, most notably its draconian anti-COVID policy, an over-indebted property sector, President Xi's war on big tech, its anti-entrepreneurial Common Prosperity campaign, and vulnerable power supply. The global services sector should benefit from a reopening of the economy, and the Eurozone looks set for a good year. The two key risks to the economy and markets remain the tension between the West and Russia over Ukraine and the drift towards authoritarianism in China. In October last year, the International Monetary Fund forecast global GDP growth of 4.9% in 2022. In its most recent update, the IMF revised this figure downwards to 4.2%. This was largely due to a more subdued growth outlook in some of the world's key economies. The United States and Britain are both expected to grow by 1/3 less than in 2021, and China and Russia by 40% less. Brazil is expected to descend into a downright recession. The exceptions are the Eurozone, where growth is expected to be only 10% slower than this year, and India, where growth is forecast to actually accelerate. For many years, Chinese GDP growth of between 7 and 9% per annum was taken for granted. Over time, the annual number crept lower as the country's industrialization approached maturity. Nevertheless, for the decade preceding the COVID pandemic, the average was still an impressive 7.5% per annum. 2020 and 2021 were statistical outliers, but looking ahead, the International Monetary Fund is predicting a continued decline in the annual growth rate. Thanks to an aging population, higher labor costs, and some eccentric government policies, the average growth rate for the next 5 years is projected to be a relatively modest 5.2% per annum. Another indication that all is not well with the Chinese economy is the trajectory of inflation in that country. Even as Western economic blocs like the US, Britain, and the Eurozone are battling sharply rising inflation, inflation in China has actually trended downwards in recent times. The only other major economy where inflation is not a major headache is Japan, but as we all know, Japan has been battling a stagnant economy and deflation for decades now. On equity markets, January's biggest losers were technology stocks. The Nasdaq was particularly hard hit, as were the tech giants among the S&P 500. US money market rates are currently pricing in 4 quarter-point rate hikes this year, but the bond market appears more sanguine. Goldman Sachs predicts that Brent crude oil will reach $100 a barrel soon, and European gas prices are also at multi-year highs. Commodity prices are mostly higher, but Netflix and Bitcoin endured a month they would rather forget. Despite January being a generally poor month on global equity markets, some of the major indices did manage to eke out positive returns. Among them were the Hang Seng, the FTSE 100, and the JSE's Top 40. Among the major losers were the Kospi in South Korea, the Nasdaq, and the Nikkei 225. Over 1 year, the CAC 40 in Paris remains the best performing major index, and mainland China's A50 index the worst. Over 3 years, the Nasdaq continues to reign supreme, with the Hang Seng the wooden spoonist. Despite all the talk about an imminent green revolution, the oil price looks set to reach $100 per barrel. The explanation for this is actually quite simple. The transition from carbon-based energy to renewables is going to take much longer than hoped for, which means that the demand for oil and coal is unlikely to diminish in the near future. At the same time, supply is not keeping pace with the growth of the global economy. This graph depicts how the recent rise in the price of Brent crude oil, the black line, has coincided with a sharp drop in capital investment in the oil industry, the blue line. Producers are clearly hesitant to invest heavily in new projects which may only start producing output at a time when renewable alternatives are readily available. In sharp contrast to the mayhem on equity markets, most commodity prices rose in January. The action seemed to center on the energy sector, where coal rose by more than 33%, Brent crude oil by more than 13%, and natural gas by nearly 12.5%. Although the prices of other battery metals rose, lithium declined by 7%. Over 1 year, lithium, however, remains the best performing single commodity, and iron ore the worst. Looking ahead, we believe that a combination of higher interest rates and disrupted supply chains will dampen economic activity. Against this backdrop, equity returns are likely to be more modest than last year. Nevertheless, the more challenging environment does not mean that decent returns are not achievable, only that markets will in all likelihood be more volatile and that last year's winners and losers may reverse roles. The outlook for fixed income and cash is less rosy, however. Even though yields will rise in nominal terms, higher inflation means that they will remain low in real terms. Even though commodity prices are unlikely to repeat last year's strong performance, continued economic growth should support prices. Here at home, the battle for the soul of the ANC heated up even further in January. Tourism Minister Lindiwe Sisulu seems determined to become the pro-Zuma faction's candidate for the party's leadership at this year's elective conference. First, she blamed the constitution and conservative black judges for the country's slow transformation, and when reproached by President Ramaphosa, she insisted that she hadn't apologized and in fact hadn't said or done anything to apologize for. The President has thus far not publicly rebuked her nor taken disciplinary steps, which seems to suggest that she enjoys considerable support among the party rank and file. By the end of January, more than 3.6 million South Africans had tested positive for COVID-19 and more than 95,000 had succumbed to the disease. Even though the Omicron variant continues to spread like wildfire, hospitalization and mortality rates are low compared to the 3 previous waves of the pandemic. This has prompted the Coronavirus Command Council to further relax COVID restrictions. Schools will return to their pre-pandemic routines, and people who test positive but are asymptomatic will no longer be required to self-isolate. Those who do present with symptoms will henceforth only have to isolate for 7 days instead of the original 10. Meanwhile, more than 30 million doses of vaccine have now been administered. The only remaining vestige of anti-COVID measures is the mandated wearing of masks in public. Inflation is now approaching the ceiling of the Reserve Bank's 3 to 6% target range, mainly due to a sharp rise in fuel prices. The petrol price is once again above 20 Rand a litre, more than 40% higher than a year ago. In response, the Reserve Bank hiked the repo rate by 25 basis points in January, with 3 more similar hikes expected this year. Eskom wants to hike electricity prices by over 20%, and government has secured a World Bank loan of more than 11 billion rand. Farmers are now complaining that they're getting too much rain, and lovers of fish paste are mourning the demise of red roe and anchovette. This graph shows clearly how instrumental rising fuel costs have been in pushing inflation higher. Headline inflation, the light green line, reached 5.9% in December, even though food inflation, the dotted line, fell sharply during the fourth quarter of last year, and core inflation, which excludes food and fuel, remains subdued at only 3.4%. Let us hope that the National Energy Regulator does not allow Eskom to hike the price of electricity to the extent that it wants to, and that the Minister of Finance resists the impulse to raise the fuel levy even further in the upcoming budget. The Minister of Minerals and Energy, Gwede Mantashe, has been widely criticized for insisting that coal would remain South Africa's main source of energy for decades to come. But he does have a point. We do have some of the world's biggest deposits of thermal coal. We do rely massively on coal-fired power stations for electricity generation, and coal mining provides the country with huge revenues and thousands of formal sector jobs. This graph shows just how difficult and expensive it will be to turn South Africa into a low-carbon economy. Around 75% of our country's energy is extracted from coal, making us by far the most coal-intensive economy among the G20 countries. A mini rally during the last week of January saw the JSE All-Share Index end the month in positive territory. Resources and financials ended the month up, but industrials were sharply down. The rand also managed to claw back its earlier losses against the US dollar. Bond yields weakened, but higher than expected tax revenue should support government bonds over the medium term. MTN's Nigerian venture seems to finally be paying off, and Sibanye is adding to its platinum empire. Coca-Cola Africa's listing should boost interest in the JSE, and Old Mutual dodged a bullet in the Johannesburg High Court. On the JSE, the past year was generally a good one, with most sectors posting double-digit positive returns. The best performing sector was energy, with Sasol the standout individual share. Telecommunications received hefty boosts from MTN and Telkom, and consumer stocks were led higher by a rampant Shoprite. The JSE's sore thumb was technology, dragged down by the travails of Naspers and Prosus. Despite having enjoyed a strong 2021, the JSE has by no means become expensive. If one uses the forward price-to-earnings ratio as a measure, our market actually offers good value, both relative to its international peers and to its own history. The S&P 500 is currently at a forward PE of 21.5 times, and the MSCI World Index, excluding the USA, just above 14 times. The JSE is not just cheaper than its peers at an average PE ratio of 9 times, but it is also well below its own long-term average of 12 times. Looking ahead, we expect this year to be a more challenging one for the global economy and investment markets. This is due to a number of factors, including tighter monetary policy, moderating global growth, and a diminishing trade surplus. Even though returns from equities are expected to be more muted this year, they should still come in well in advance of inflation and higher than those on bonds and cash. We are positioning our equity portfolios in a more defensive manner, with a focus on quality companies and fewer cyclical stocks. We expect non-resource rand hedges to outperform cyclicals, and we remain positive on bond yields, provided government makes it clear that it's serious about avoiding a debt trap. The current Adviceworx tactical asset allocation view can be summarized as follows. We see value in domestic equities and are looking to increase our exposure to this asset class by 1 to 2%. We retain our overweight position in domestic bonds and our underweight position in domestic cash. We also retain our underweight position regarding domestic property. On the international front, we are still positive about equities despite the stretched valuations, and we retain our maximum underweight position relative to global bonds. As far as international property is concerned, we remain positive on the asset class. Thank you very much for your time and interest. We certainly live in interesting times, and I hope that the contents of this presentation will help you make sense of it all. Should you have any questions or queries, please don't hesitate to contact me or your Adviceworx financial advisor. I wish you good luck and good health until next time.